Hello everyone, thanks for checking out my video. 2024 is off to a rough start for the US stock market. All three major indexes ended their impressive 9-week winning streak, with the tech-heavy Nasdaq suffering the biggest decline of about 3% in 1 week, its worst weekly performance since September last year. Specifically for Apple, it has lost more than $150 billion in market cap to start the new year, following downgrades from analysts. As for S&P 500, this is their worst start to a year since 2016. This sudden pullback has caught many investors off guard. The questions many of us have right now are, were there too much optimism being baked into the market previously? Are investors overconfident about 2024? How long will this hangover from 2023's rally last? Let's break down some of these questions in this video, so do stay tuned throughout the video, alright? So, the US stock market slumped in the first week of 2024, which marked a reversal of 2023's massive rally. Not only had it ended the longest winning streak since 2004, it was also S&P 500 worst start to a year since 2016. Some attributed this pullback to profit-taking by investors, especially in the tech industry, given their monster rally in 2023. On top of that, new jobs report has also intensified the debate about when will the Federal Reserve cut the interest rates. The latest jobs report shows that in December, US added more jobs than anticipated, with non-farm payrolls growing by 216,000 vis-a-vis the expectation of 170,000. The unemployment rate remained unchanged at 3.7%. Both numbers are pointing towards a continued resilient labour market. This is potentially bad news for the stock market. To put it in layman terms, a strong labour market could mean that the Fed might just delay the first rate cuts, which the market has eagerly anticipating and speculating. Currently, investors are leaning towards the possibility that the Fed will cut rates during March's meeting, but the latest jobs report has pushed down the odds from above 70% to about 60-ish% at the time of recording this video. Meanwhile, the latest jobs report has also sent Treasury yields surging higher, with the 10-year Treasury yield going slightly above 4% again as of the time of recording. Again, this is not a good news for the stock market. This week, we will have a fresh set of inflation data, which is the CPI report, scheduled to be released on Thursday, 11 January. This is highly anticipated by both the market and the Federal Reserve before the next FOMC meeting towards the end of this month. Both parties would like to see if the current inflation is making further progress, or has it reached a very sticky and stagnant stage. Then on Friday, the new earnings season will get underway, with the banks leading the way as usual. A host of major US banks, including JP Morgan Chase, Citigroup, Bank of America, and Wells Fargo, will be reporting their fourth quarter 2023's earnings. Investors will hope to get some insight into the health of the US economy and how American consumers and companies are doing heading into 2024. Interestingly, in the last 1 month, most major US bank stocks have rallied, likely because of the forward-looking nature of the stock market. Basically, the stock market is anticipating the banks to put behind the tough high-interest environment of 2023 and looking forward to potential rate cuts in 2024, which should benefit the banks. Let's now move over to the technical analysis section. Do pay attention to SPY because it kind of represents the broader US stock market. So in my last video, I shared that I did not mean to flip-flop my words, as I was merely presenting what I saw on SPY's chart. I then shared 3 bearish signs of SPY, which were bearish divergence on RSI, MACD's bearish cross, and the unusual high volume of sell-off. I also mentioned that if 475 breaks, there is really not much support all the way to 467. And so, SPY's bearish thesis really played out, and look at where SPY is right now, 467.9. Please do give this video a like if you have benefited from my technical analysis last week. Anyway, when I zoom out of the chart, you will be able to see that SPY has been moving within this green uptrend channel. In one of my previous videos, I cautioned that when SPY hit the top end of the channel on 3 occasions in the past, it fell back down each and every time. Right now, it seems like the same thing is happening as SPY got rejected by the top end of the channel. To be honest, I'm not sure whether will it fall back to the bottom of the channel just like the previous occasions, but I think the chance of at least falling to the middle of the channel is high, which roughly coincides with the first Fibonacci retracement level at around 461. Anyway, it's up to you whether you want to trade based on this probability, for instance buy a put of 461 or sell a covered call on SPY. Anyway, this is not a financial advice, okay? But 461 is the one support level that I will definitely keep an eye on this week. If it breaks, SPY may just fall all the way to sub 450 where the next Fibonacci level is. This is also where the 50 moving average sits, which I think should offer a decent support. But be very careful here, because if this level breaks, there is a high probability that SPY will waterfall towards the gap between 439 to 444. On the other hand, if we can get a bounce from the support 461, then it's very bullish. It means that investors and institutions were taking some profits off the table at the start of the year, cooling off the indicators in the process, and then we are ready to charge higher. A bounce from 461 also means that there is a decent chance of us creating another new all-time high above 477.5. That being said, even if 461 gets breached this week, I think bulls need not worry yet. The pullback can still be considered healthy all the way to the 50 moving average area, which is around 450. It's only when 450 breaks, okay, then we need to talk again. That's when the broader market will be quite bearish. It could be a start of a new bearish period, something similar to July to October 2023 period, where SPY fell from the top end of the channel to the bottom end. That's 3 months or 1 full quarter of a bearish period. Let's now move over to Apple. Okay, I got to be honest with you, I did not expect Apple to fall that much last week. Who would have expected 2 downgrades in 1 week, right? So yeah, I have to admit that the big decline caught me off guard. But it's important to always stay nimble and act according to the situation. More on this later in the options trading section. Anyway, 9 red candles out of 11 trading days. I don't think you need me to tell you that Apple is looking super bearish. In fact, the RSI indicator has not been so oversold for years. So what's next? More dumping of Apple shares? Well, come this week, there is one super duper important area to watch. I repeat, pay attention to this area that I am going to share. This support area is between 176 to 179. Why so? Largely because it's where the 200 moving average sits. Let me zoom out the chart for you. As you can see, ever since Apple hit the rock bottom almost exactly 1 year ago on 3rd January 2023, it has been trading above the 200 moving average. Though on 2 occasions, specifically in March and October 2023, Apple briefly fell below the moving average. It rebounded up quite quickly within a week. Right now, the 200 moving average sits at around 179, and to give a bit more buffer, I have added the all-important 61.8 Fibonacci level of 178 into consideration as well. But, like I always said, market makers don't move the stock so nicely for you, so we may get a forced breakdown below 178 and then bounces up. To counter that, I decided to stretch the support zone all the way to 176. And that's how I get 176 to 179 range. I repeat, watch this area very carefully this week. If this area gets breached, I think we will be looking at 173 where the next small support level is. Here's a saving grace for the bulls. I have not seen Apple get sold to this level on the RSI for years. It only happened 4 times in the last 10 to 11 years. In 2021, 2018, 2016 and 2013. Okay, I know oversold stock can remain oversold, but as mentioned earlier, stock moves in a zigzag pattern. Therefore, I am expecting some form of relief this week. Just to clarify, it may not be a huge bounce. It can be a small bounce or just sideways movements. I think it's unlikely we're gonna drop another 6% this week. And because of this, I sold cash secure puts last week on Apple. More on this later. Anyway, resistance level is at 182.5. Reclaiming this is nothing actually, because market makers can bring the stock up to fill that little gap at 183 and then bring it down again. Bulls will need Apple to go back above 187. Then we can say that Apple has stopped its rot for now. Why 187? Because that's where the 50 moving average and the other Fibonacci levels sit. Let's now move over to Tesla's chart. It seems like investors didn't like Tesla's latest delivery numbers as it dropped more than 4% last week. But in Tesla's context, 4% is quite nothing. I mean, Tesla can easily move up or down 5% in a single day or even 10%. That being said, Tesla obviously looks weak right now. Other than 5 red candles in 6 trading days, it is important to note that Tesla has fallen below the purple downtrend line and green uptrend line. I shared in my last video that the conversion point of these two lines have to hold, otherwise Tesla is bearish. By the way, I also highlighted 3 bearish signals in that video. You can check out the video if you haven't, I have linked it at the top. But basically, I explicitly shared that I was leaning bearish towards Tesla last week, and Tesla declined indeed. I hope that can earn a like button from you if possible. Anyway, Tesla is approaching an important support zone, which is between 229 to 234. This area is formed by the 50 and 200 moving averages, as well as the 50% Fibonacci level. To also highlight, since we had that gap up in November 2023, Tesla has been floating above the 230 to 231 area. Therefore, this entire 229 to 234 is one important zone for the bulls to protect. If the bulls get overwhelmed by the bears, the last line of defense stands at 221, which is the all-important 61.8 Fibonacci retracement level. If that breaks, I'm not trying to scare you, but I think we can say hello to below 210. Okay, before I talk about the upside, no product placement, but please allow me to do a quick shout out to garner support for this channel. If you have been following me, you would have known that I have started this channel about 2 years ago and I have not gotten a single paycheck from YouTube. The minimum cash out amount is 150 Sing dollars, which is around 113 US dollars. Right now I am sitting at only about 19 US dollars, so that's about 94 US dollars more to go. So, if you like my content and if it's within your financial means, do consider buying me a super thanks. Any amount is much appreciated. Let's hope I can get my first paycheck from YouTube soon. It's just a little milestone that I hope to achieve. Otherwise, you may also show your support by simply liking my videos and subscribing to my channel and sharing it with your friends. Alright, in terms of upside, Tesla needs to get above both the trend lines that I talk about. If I were to put a number to it, then I would want Tesla to get above the Fibonacci level at 248. That's when we can say Tesla has once again broken out of the purple downtrend line and is sitting above the green uptrend line. And the longer we stay above 248, the higher chance for Tesla to hit 260s again. Above 260, there are 2 levels to watch, namely 265 and 269. We need a clean breakout from these 2 levels for Tesla to be very bullish. If it somehow gets rejected between this 265 to 269 area, that's actually quite dangerous, because it may potentially form a triple top bearish pattern. Alright, finally let's check out Google. Honestly, I don't know what to comment about Google. I am saying this in a good way. I mean, its movement is so predictable, such that it's so good for option traders. In fact, I think it's my second most traded stock behind Tesla. I trade Tesla is because of its volatility, while for Google, I trade it for its predictability. Anyway, gonna bring back this consolidation zone of 127 to 139 again. It seems like Google had a failed breakout after kissing 142. It did stay above 140 for about a week, which gave investors hope that it could go higher. But unfortunately, it turned out to be a false breakout, something similar to October 2023's movement. As a result, it forms a bearish double top pattern. Just to highlight, the MACD just turned bearish last week, which is a bad sign. Additionally, it is also in this mini downtrend channel. Actually, how cute, right? The way the candles line up so nicely within that small little channel. Anyway, if Google continues to follow its predictable movement, then 127 or 128 is the next target for the market makers. But before that, watch for 133. This is one solid support level which could invalidate the movement towards 127. It's a strong support because it's where the all-important 61.8 Fibonacci level and the current 50 moving average are. If 133 breaks, then I think we have a pretty high probability to see 120's range again. Personally, I am waiting for opportunity to sell cash secure puts this week. On the upside, quite straightforward. You can try drawing that downtrend channel on your chart as well. So for Google to reverse its bearish momentum, it needs to break out of this cute little downtrend channel. Once out of it, again, it may just follow its usual movement and head towards 139 to 140 again, before the sellers start stepping in. If only we can have a clean, like a real clean and solid breakout above 140, then Google can be said to be bullish. Otherwise, it is just consolidating between 127 to 139 again. Okay, at this point, I don't see any catalyst for Google to have that sort of solid breakout unless CPI figure drops a lot and the market rallies as a whole. Otherwise, the next catalyst will be Google's earnings, which is around the end of this month or early February. Alright, let's now talk about my options trades. I sold 2 new cash secure puts on Apple last week, one on 2nd January and one on 5th January. The rationale behind the trade was pretty much similar. Firstly, I am of the view that the market was overreacting when Apple was downgraded by Barclays on 2nd January. On that very same day, we had a huge gap down. It's quite rare for that to happen given the size of Apple's market cap. The last 2 occasions where we had such a big gap down were in August and September 2023. On both occasions, yes, Apple did fall further down a little, but then we had a bounce up after it got really oversold. And this decline followed by a bounce movement all took place in about a month or so. That is the reason why I sold these 2 put contracts that are about 1.5 months out, in anticipation of a potential bounce. By the way, if you had realized, I rarely sold 2 puts on the same stock in one single week. The reason why I doubled down on Apple, also the second contract, was because it was so damn oversold on the RSI. As shared earlier in the technical analysis segment, Apple's RSI had only hit this level 4 times in the last 10 to 11 years, in 2021, 2018, 2016 and 2013. That's like once in the last 2 years, twice in the last 5 years, thrice in the last 7 years, and yeah, 4 times in about 10 years. I know the RSI indicator can float around this oversold level for a while, but I am playing the probability game. I think probability is slightly favoring a sideways movement or a small bounce or relief. If that plays out, I will let time decay do its job. Also, I believe I have selected 2 decent strike prices as they are both below the 200 moving average. Again, as shared earlier, Apple has only fallen below this 200 moving average twice since it started this monster rally in January 2023, and on both occasions it did bounce up. Not just that, if let's say the RSI starts curling up, then we potentially have a bullish divergence on the indicator. The last factor that I have considered was that Apple has fallen out of the Bollinger Band for 4 straight days. Again, such bearish sign is very rare for Apple. It could be due for a small little relief. But of course, market is unpredictable. If the trades go against me, I may decide to take assignment for one of the 2 contracts because I need more Apple shares. Okay, 2 more trades to update. I have 2 cash secure puts that are expiring this Friday, 12th January. One on Tesla with a strike price of 205 and the other on Google with a strike price of 125. If Tesla and Google don't fall below its respective strike prices, both contracts will expire worthless and I will get to keep the full premium without doing anything. And then I will try to see if I can open a new trade on Google based on its predictable movement. The rationale behind both trades was shared in my past videos, so if you do not want to miss any updates on my future trades, do stay subscribed to my channel. Alright, some thoughts of the recent market pullback. As we can see, the US stock market has lost their footing a little as we entered 2024, which is a stark contrast to the strong Santo rally that concluded 2023. The market and general investors, or at least myself, are attributing the pullback to a few factors. First and foremost, it's profit taking. After a monster run-up in 2023, it is unsurprising that some investors would want to lock in their profits at the start of the year as the market gets overheated and overstretched. Which brings me to the second factor, technical. The latest pullback can be seen as a technical retracement until proven otherwise. As mentioned, the market has been overbought and overstretched towards the end of last year. Purely from technical point of view, pullbacks are necessary to cool off chart indicators before it can go higher. The simple theory behind this is that market doesn't move up in one straight line, it's always in a zigzag pattern. Third factor is something that I have shared in my very last video, expectations. Expectations of rate cuts by the market versus the actual rate cuts. If you could recall, Jerome Powell gave a dovish speech towards the end of 2023, and from that point, the market rallied as they anticipated an early rate cut in 2024, as early as March. But right now, doubts have set in on whether the Fed is prepared to pivot so soon. The latest surprisingly hot jobs report could add pressure to the Fed's decision, as they may want to hold the current rates and delay its first rate cut. This has definitely dampened investors' hope that the tightening campaign has come to an end. There is a potentially mismatch of expectations here. Just to share, prior to Friday's jobs report, the market was very hopeful of a rate cut in March and expect Fed to lower the rates by as many as 6 times this year. To me, this could be overly optimistic, and these expectations will probably have to be dialed back. A strong labour market and wage growth could fuel a rising inflation again. All in all, coming into 2024, investors have 3 main things on their wish list: falling inflation, stable and yet not too hot job market, and of course rate cuts. But I think investors cannot be too greedy, or at least be mentally prepared that we may not get all 3. Any misalignment of expectations could result to a pullback that we have seen in the first week of 2024. I think by now, we all can acknowledge or agree that the stock market has a rough and tough start to 2024. But in my opinion, this should not come as a surprise. The 9 consecutive weeks of weekly gains will definitely come to an end, something that I said in my very last video. Okay, but I wouldn't say I have made a correct call for this pullback because it has always been a case of a matter of when, not if. Pullbacks are inevitable and imminent, but at the same time, it presents both trading and investment opportunities. So embrace it, okay? Alright, that's all for this video. Please help me in growing this channel by tapping on the like and subscribe buttons before you exit. Thank you.